With the S&P falling more than 20% since the start of the year, it's now a good time for us to invest and buy the dip as they speak. Now in this video, I'll share with you on my personal opinion whether or not it is a good time for us to invest in the S&P given what's going on today. Now quick disclaimer, none of what I am sharing in this video is financial advice. If you want to receive personal financial advice, reach out to me directly. Please do your due diligence before making any investment decisions. With that out of the way, let's get started. Personal stance. Now based on where we stand today, my stance towards the S&P 500 is neutral. I wouldn't consider investing in it on a lump sum basis at the moment, as at a price level of 3.7 to 3.8k, the expected return on the S&P 500 over the next 5 to 10 years is not that attractive. Now based on the fundamental analysis and an assumption of a 6% yearly growth in the 3 years average earnings per share, we can expect to receive a return of negative 2.5% to 8% over a 5 years investment horizon, and a 1.67% to 6.99% over a 10-year investment horizon. And while the price to earnings multiple had came down to its long-term average, there is an imminent risk of earnings recession. And this essentially renders the 1 year's earning and price to earnings ratio to be unreliable. And that is also the reason why we are basing our calculations off the 3 years average figures instead, to iron out the short-term ups and downs in the earnings. That said, realistically speaking, investing in the S&P 500 today will provide you with a return of 3.3% a year over the next 5 years and 4.63% a year over the next 10 years. Based on the technical analysis of the weekly chart, the readings also suggest that there is a higher probability of further price decline as opposed to a price increase. Additional considerations to be had. Now apart from the fundamental and technical analysis, here are also some factors that you might want to take into account in helping you shape your investment decision. Firstly, the probability of a US recession by 2024 has risen to an all-time high, at the back of the Federal Reserve's aggressive rate hikes and the reduction in their balance sheet in an attempt to fight against inflation. Now regardless of whether the Federal Reserve can or cannot achieve a soft landing, it is safe to assume that its action will have an adverse impact on the growth of the economy, as the GDP growth is expected to slow down while the unemployment rate is expected to increase. Now while this doesn't automatically translate to poor market performances, the sudden change in economic fundamentals does have a negative implication on investor sentiment, which more often than not drives short-term price actions. In addition, given the current valuation that S&P is trading at, the probability of a further price decline is higher as compared to a rebound in market prices. Secondly, in an environment where most developed economies are tightening their monetary policies and raising their interest rates, it is worth taking note that the developing markets are the only markets that are not as aggressive as the developed markets in the recent tightening wave. As a result, from an economic growth perspective, while economists estimate a declining global growth of 2.9% in 2022, the emerging markets are the only countries with the higher than average growth rates as they originally should. Now, growth investors who are more aggressive would have a higher chance of outperforming the US markets by focusing on the emerging markets, which, at the time of recording, have a higher growth rate potential and are trading at levels that are within the undervalued range. That said, investors should be cautioned with regards to the global implications of a US recession, as well as the correlation between the US equities and other equity market, instead of blindly chasing after growth. Closing statements. Now all things considered, I wouldn't invest in the S&P today based on the current prices, given the expected return over 5 and 10 years is not justifiable for the level of risk that we are seeing today. That said, there are still ways for us to work around the current investment climate and structure an investment portfolio that can deliver the returns that you need to accelerate your wealth accumulation goals. If you do not know how to get started with your investments, or if you do not have the time to manage your investments, you can check out what I do on my website to see how you can benefit from my investment planning services and reach out to me directly. Do subscribe to this channel and follow me on Instagram or Telegram to receive a 1-minute daily market update and be updated with the weekly upload. Now stay safe and I hope to hear from you soon.